Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning, welcome to the show. Of course, it is Thursday, second best day of the week. Michael Lebowitz joining me just a little bit to talk about why QE may just be set to return in the market. So we'll get into that this morning. Also, other news, of course, the government shutdown is now over. The Democrats have now caved, well, I shouldn't say caved, but 10 of them voted to actually fund the government all the way through the end of the year. So we've got a shutdown done just in time, as we talked about yesterday. Very important, travel, right? So it gets all the airplanes back in the air so everybody can get to where they want to go for grandma's house on Christmas, because that's what's coming up, and Thanksgiving as well. But most importantly, we go to grandma's house on Christmas. So, right? I mean, through the woods, and you know the story, right? It happens. So, yeah, exactly. She gets run over by reindeer. So anyway, that's good news. So the longest government shutdown in history will now conclude. The government should reopen by Wednesday. As we talked about before, that's a lot of government cash coming back into the markets as well. So that should help give a little bit of tailwind to the markets as we're to head into year end. So again, good news all around, but more importantly, we'll start to get economic data back. So now the markets can go back to actually looking at economic data and seeing what that has to say. Now, a lot of the off-the-run indicators suggest that inflation dropped in the last month, employment slowed a little bit in the last month, but consumer credit card spending actually ticked up in October. Not surprising. You know why? Brent, do you know why consumer spending picked up in October?
Halloween, baby.
Did you know that Halloween is the second largest spending holiday of the year?
Yes.
Behind Christmas.
Yeah.
Yeah. So.
And you've seen the price of chocolate lately.
And costumes.
Oh, yeah.
Yeah.
Costumes.
So, yeah. Everybody's starting to really kind of up their game on the costume front. So,
Yeah.
So anyway, credit card spending picked up in October, not surprising. We'll see if that can carry through November and December. Of course, you got a lot of holidays coming up, spending for Thanksgiving, spending for travel, spending for Christmas, got to buy all the presents, of course, travel for that as well. So again, we should see potentially some consumer pickup here, and of course, some increase in credit card debt as we go through the end of the year. So all of that should bode well, right? So we get some good retail sales numbers. If that comes in, we get some economic data that shows a little bit of resilience in the economy. That could all bode well for the markets into year end. Again, we're in that seasonally strong period, so just be a little bit cautious with headlines. But speaking of markets, let's talk about what you need to know before the bell this morning. Yesterday, the markets put in a fourth positive day of returns. Very nice, getting back above that 20-day moving average. Now starting to challenge back towards all-time highs. The Dow actually yesterday did set an all-time high, crossing 48,000 for the first time in history. So again, just, the calls for Dow 50,000 back in 1995, going to finally get there. So there we go. So anyway, but look, the bull trend remains firmly intact here. We're about to trigger a momentum buy signal here as well. RSI continues to improve here. So again, getting a little bit of buying into the markets. Brent also improving in the markets. We're seeing advanced decline lines, particularly in the tech sector, starting to pick up here a bit. But as I've talked about lately, we've really seen a bit of a rotation in the overall markets. And again, if you take a look at different sectors, like for instance, healthcare has been doing exceptionally well. So while tech has kind of been lagging as of late, and again, if you look at the technology sector as a whole, it's kind of been hanging in there right now. It's had a bit of a correction, been rallying back here the last few days. Still on a sell signal here. Relative strength, overbought condition, relative strength is getting worked off. So we're going to be in a position here soon where tech is probably going to start catching some flows in the markets, but while that weakness has been occurring in tech, particularly in those big mega cap stocks, et cetera, as I was just showing you, healthcare has been doing just fantastic. A lot of companies in here setting new all-time highs. So again, just been a bit of a rotation within the markets coming out of technology, which we talked about for weeks, was extremely overbought. needed to have a bit of a respite, and that's what's been occurring in a lot of these big tech stocks. At the same time, that money has to go somewhere, and it found its way back into healthcare, which was extremely oversold. Now, one area that's still under a lot of pressure continues to be staples, but as we've talked about previously, starting to see a little bit of rotation back in staples. Not a lot yet. We're not seeing that push into like we're seeing in healthcare right now, but staples are triggering a buy signal from a fairly low level, and relative strength is still very oversold and starting to improve. So we're starting to see some positive signs here. A lot of negative overhead pressure on staples right now, particularly all these moving averages that are sitting on top of staples. But if the if staples can start to cling on to the 20-day moving average, get above that, potentially get above the 50, you're going to start to see some momentum starting to come back into that sector. We should start to see some rotation back into that sector when that occurs. Outside of that, discretionary, of course, this morning Disney reporting earnings are also increasing their buybacks. They did beat estimates, so we'll see how the stock does today. But the problem with Disney is they just make crappy movies. So, they brought Bob Iger back, right, to fix things, because they destroyed their two main franchises, Marvel and Star Wars, right? Completely killed that. And on this whole idea of whatever you were doing with your movie structures, but I got some ideas. But they bring Bob Iger back to fix it, and he does nothing to fix the problem. They continue to make crappy movies. Nobody wants to see that stuff anymore. And of course, the stock's down another 3% this morning after a report. So, just go back to do what you do well, right? Entertain people and leave all the politics at the door. You'll be a lot better off. Yeah, exactly. So quit messing with Snow White. Leave that alone. Anyway, But take a looking at discretionary. Discretionary, of course, this is primarily Amazon now, but that's been holding up fairly well here. But again, we'll see what happens within this sector. But again, when we start looking at the consumer as a function, and again, this is the one thing about staples. Just a real quick trip back over to staples here. The one thing that kind of bothers me is that this is really a more of a sign of economic activity. So again, if you strip out Amazon from the discretionary sector and Tesla, which are basically the two stocks that drive that discretionary sector, there's not a lot of activity going on over there. So again, when we take a look at the overall economy, just be a little bit more cautious about that. And lastly, of course, finance, which is one of your other big components in the overall markets. Finance has been doing well, coming back up here, triggering a buy signal here from a decently oversold level, relative strength improving. So again, we're seeing a little bit of rotation, again, out of tech into some of the areas that were more beaten up, which was finance, staples, and healthcare, starting to see that occur here. So again, that's starting to increase the breadth of the overall markets and starting to provide a push here that should help the market support into year end. Anyway, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
right, welcome back to the show this morning. Michael Lebowitz joining me as well. So, a couple of things going on. Again, is kind of just, kind of talking about markets, the economy, what's happening. Of course, the big concern right now is whether or not the Fed's going to cut rates at the next meeting. Of course, right now, from what we're seeing on kind of most of the front is that we are seeing economic data slow down enough, at least from some of the off-the-run indicators, that we're very likely going to see another rate cut by the end of the year. There's really nothing kind of stopping the Fed from cutting rates by the end of the year, at least at this point. Of course, the big question becomes, again, you're cutting rates into a period of time where expectations are high that we're going to see an economic recovery next year. In other words, the economy is going to start gaining strength. This is the expectations. I'm not saying this is a true fact. I'm just saying the expectations are we're going to see an economic resurgence next year, primarily due to all of the build out of AI infrastructure next year. That's going to be a very large multiplier impact. And there's a lot of people running around right now going, oh my, these companies are spending all this money on AI. And that's true, they are. But it's going to create a lot of economic activity. You're talking on terms of about $5 trillion worth of spending over the next 4 to 5 years. That has about a 3 to 4 to 1 multiplier. So you're talking about a 15 to $20 trillion impact on a $25 trillion economy. So again, on a real basis. So, that's going to have a major impact on what happens in the rest of the economy, and also drive a lot of what happens in the markets, because all that money is going to get spent by the people that are receiving those funds from the build-outs, right? So all the infrastructure goes to the construction workers, et cetera. They spend money in the economy. That creates more revenue, more economic activity, so forth and so on. So there's going to be a lot of stuff that's going on as we move into next year. And the question is, you're cutting rates and loosening financial conditions in that environment. So you potentially run the risk of causing an overheating in the economy, a pickup in inflation, those type of things. Again, rising inflation in an environment where you have stronger economic growth is not a problem, right? So again, that you should expect higher inflation. If you have robust economic growth, 3-4% economic growth, you should expect 3 to 4% inflation. Those two go together. But so then that's not a bad thing, because wages will come up. That's going to happen as well. And again, even the White House is now seeking to raise wages for hourly workers. So we're starting to see a push, right, for higher wages. But again, it's just a very interesting situation that we've got the Fed on this path to cut rates, and the markets are expecting a much stronger economic output yet next year. So again, how this eventually works out is going to be interesting, because normally the Fed's cutting rates when the economy is really, really weakening, and they're cutting rates to try to restart economic activity, or at least buoy economic activity. But that's not happening this time. So again, this also kind of brings us up to the point of recently the Fed just also announced the reduction of QT to zero. And that's going to end at this month. It's not like they said we're going to stop QT in a couple of months or the end of the year. It's like, no, we're going to end QT at the end of the month. So what's the rush? And for that, we'll talk with Michael Lebowitz. Good morning, Mike. How are you?
I'm doing well. How are you?
Good. So, yeah, I mean, what is the rush to cut rates here?
I think it's a very confusing environment for the Fed. Like you said, the AI data center spend is tremendous. It's massive. But at the same time, 70% of your economy, personal consumption, is showing signs of weakness. I'm not saying it's dead, but it's certainly showing signs of weakness, especially at the lower ends of the economy. So I think the Fed, which is always more focused on the traditional economic numbers, right? The employment numbers, retail sales, consumer spending type numbers from the PCE, all that stuff. They're probably a little more focused on the consumer and not as focused as much on what you were talking about earlier, how that AI money works itself into the economy, right? It's not just that they're building a data center, it's that there's people building it. It's all the services that help those people build it. It's, people then work there. So it does have a positive impact. So you have these two battling forces at the economy, and the Fed still doesn't even know which way inflation is going. They've been confused about that for a while. who knows what they haven't had economic data in 2 months either, right?
Well, they've okay. Let's be honest. They've got economic data.
Oh yeah,
I mean, they've got look, if you've got 400 PhDs running around the Eccles building, you better be able to figure out how to get some off the run economic data.
Right. If two guys like us have it, they have it.
Exactly. You would think so anyway. The fact that the fact that it seems like they don't is more concerning.
Exactly. No, they do. But I think the Fed funds futures market speaks for itself. It's 50-50 right now as to whether they're going to cut or not. So, and I think as we get closer to that, do you know when that meeting is?
The third week of December, I think.
Okay, so
like around the 12th or 13th, something like that.
Sounds about right.
Yeah.
So, between now and then, I think we're going to hear more from the Fed which way they're leaning. Certainly, there are some that want to cut immediately, and others that don't ever want to cut. So there's still a wide margin. I think we'll see that slim down over the next few weeks, especially if we get some data. And again, I think they know this data, but when they get the data, they can then say, well, because of this, that, and the other, we're going to cut, we're going to not cut. I think that'll be interesting whether they cut or not. But to your earlier point, will they talk about QE, or will they talk about some other program that they can get banking reserves into the system to add liquidity? That I think could be, I'm not sure they're going to say anything at this meeting, but if they do say anything to that point, I think that's much more interesting.
Yeah, no, it's true. And by the way, that meeting is on December 9th and 10th. So
okay,
it's the second week of December. But no, that's kind of the interesting point, which is, we just recently talked about this. I did an interview with Michael Garrett, or James Garrett earlier this week. We'll air that on the 24th, kind of going through kind of the Fed money printing, et cetera. Garrett Baldwin. Sorry. So talk to him, and it'll be on November 24th. But talking about kind of the Fed money printing thesis, right? Is that the Fed's printing all this money, and of course there's a reserve. We had a really good conversation about it, but this is kind of the interesting thing, and we are seeing some stress in the repo market, similar to what we saw in 2019, but yet everything else is doing fine. So what's causing the stress in the repo market when everything else, markets are doing fine, everything's doing fine? What's causing this underlying turmoil for the Federal Reserve?
It's reserves.
Right.
The problem is the Fed pumped in a ton of excess reserves into the banking system in 2020, 21, and that was slowly whittled down. And we talked about that, the overnight reverse repurchase program, right? And it went up to 2.8 trillion. That's extra liquidity. And it's not just 2.8 trillion because that gets levered up. But it's a massive amount of reserves in the system. That eventually came down as the economy, as the financial markets, speculation used that leverage. And that, it's almost the day that program hit zero is the day we started to see some minor inefficiencies in the overnight funding markets. And they've become more common. Not huge problems, but they've become more common, and the Fed is publicly talking about this. John Williams from the New York Fed said, due to problems in the repo market and signs that reserves are no longer, I forgot what word he used, not abundant. I think he calls them ample now. He calls them ample now. They were abundant.
Right.
That it's likely that we're going to be purchasing assets again, i.e. QE. Or, again, it doesn't necessarily have to be QE, but some program that does the same thing as QE.
Right. Well, that was kind of part of the potential of ending QT, which is, they still have to replace, in order to keep their balance sheet level, they have to buy all the bonds that are maturing every given month. And those aren't small quantities. Those are billions of dollars, every month getting bought by the Fed. So they're not increasing their balance sheet, but they're certainly providing more reserves to the market by being a buyer.
Right. And they are, right, their balance sheet isn't changing, the size of it, but they are active in the markets. And it looks like they're going to be active, probably raising the size of their balance. So not just buying the bonds that are maturing, but buying an additional XX billion of bonds every month on a preset schedule.
Right.
So, it's basically the Fed is telling you that liquidity is scarce. I think that they're a little more, first of all, aware of it today than they were in 2019, but they also have more programs in place to try to keep liquidity in the right place. So I think they can rest a little bit more. But as we've seen time and time again, the Fed doesn't know how much, the Fed will tell you this too. They don't really know the right level of reserves and how much liquidity is the right amount to be in the markets. You don't want too much, you don't want too little. So the Fed is really in not a pickle, but I think they're concerned about 2019 and allowing that to replay again, because that can cause a lot of problems in the markets, as it did for a little bit.
Yeah, but again, I guess the question really is what changed, right? Because when you start looking at bank reserves, back pre-2007, they were like $800 billion. And that was plenty. The markets were functioning fine. They were using 10x leverage, on the reserve banking front. So, I mean, everything operated normally. Post-financial crisis, ever since then, it's been a function where we've needed these massive levels of reserves. And again, you're running, almost $3 trillion worth of reserves. Those are coming down. And now it's a concern to have, at $2.8 trillion, we're now running into liquidity problems, right? And so what's changed? Why is it requiring so much more reserves today for banks to operate versus where they were back just 2007?
So it's 2008, and this is what my last article was on. And the article gets a little technical, but I think what's really important in the article is a summary, and we'll get to that in a minute. But prior to 2008, the market sort of funded itself. The Fed was always a backstop, and at times they came in and they provided liquidity. But more often than not, the Fed was not a player every day. They targeted the Fed funds rate, and to do that, they would buy or sell assets. Every day was different. They could buy today, sell tomorrow. Mm-hmm. QE means they're buying every day. QT means they're reducing their balance sheet pretty much every day. So they used to buy and sell in the Fed funds market, but the repo markets. So repo is collateralized. It's when I make a loan to Lance, and in exchange, he sends me collateral. And that collateral basically securitizes the loan and makes it good. After 2008, the financial crisis, the banking system nearly collapsed. So the regulators went in there and changed rules. As always happens, some of the rules are good, some turn out to be bad. But among them, what they really did was they shut down those private repo markets. They made it really difficult for the banks to lend into them. The money market funds can't really lend into them anymore. So the private market over time slowly became unable to fund the overnight. Again, the overnight markets are the nexus of all the financial markets. That's the engine. Without that overnight funding, leverage collapses and all these other markets struggle. And we've seen that time and time again. So you get rid of that repo, the private repo market, something has to backfill it. And the Fed has had no choice but to backfill it. Mm-hmm. And the way they do that is with QE and other Fed repo programs. And when the Fed is transacting with banks, mm-hmm. they don't pay in cash, they pay in reserves. So reserves are almost evidence of what the Fed is doing. And if you look at a graph of bank reserves, they were flat and slowly trending higher.
I'm putting a graph up now. This is bank reserves. Go ahead.
Okay, so if you look at that graph, prior to 2008, they were just a slow, steady rising line. It went up about 4% a year in line with the economy, kind of what you would think. After 2008, it became a very volatile line, going up and down and surging at times, coming down at times. And that's kind of your evidence. That's the point where the Fed has become the provider of liquidity for the money markets, for the overnight funding markets. You also had things
But what structurally changed, though? That's my question, which is what structurally changed between 2007 in all the years before that and post 2008, where now the Fed is required to provide all this liquidity for the banks. What changed?
It's things like capital rules. It's liquidity rules. The money market funds can no longer lend into the overnight markets into the repo markets like they used to. The banks have largely been cut out of those repo markets. So that whole repo market, which funded everything, and it was a private market, the Fed kind of controlled the rates it happens, but the lending itself was in the private market went away.
Gotcha.
They were disincentivized or, in some cases weren't allowed to do certain things. That's like I'm not going to bore you here, but the supplementary leverage ratio, the liquidity coverage ratios, those had a massive impact on liquidity that the free market could provide. Proprietary trading rules. Banks used to have their own books. They would have their own trading books. And when things got out of hand, they could go in there and use arbitrage or just take advantage of opportunities. But what that really means is they could provide liquidity when there was none, make a lot of money for themselves, but serve a purpose to the markets. Remember prime money market funds?
Oh, yeah.
Those pretty much don't exist anymore, at least not the way they used to. Prime money market funds were money market funds that took on a little risk. And a money market fund is a place you expect to get all your cash back. You almost think of it as a treasury, as a risk-free asset. And that's what everyone did. But prime money market funds owned the reserve fund owned some Lehman bonds. And one day we come into work and we find out that the reserve prime money market fund is worth 97 cents on the dollar. They broke the buck. That's a cardinal sin. That's one of the 10 commandments. You don't break the buck. So when that happened, they said, okay, prime money market funds, from now on, you're only owning government securities. And that's another source of liquidity that got drained from the market. So the point is all this: the regulations to protect the financial system prohibited them from providing that overnight liquidity to the markets. The Fed stepped in via QE, via all these other repo programs to provide liquidity to the markets. So now the question is, pick your poison. Who do you want managing liquidity, the free market or the Fed? The free market was had many problems too. 2008, right? They were providing too much liquidity to the market. The market was heavily leveraged in subprime and real estate and other things. 2000, this happened as well. So you had your bubble, you had your burst. Same with 2000. And there's a history of bubbles and bursts. So the Fed takes over, kind of providing liquidity because they don't want to upset the apple cart. And here we are today where you're starting, call it a bubble, don't call it a bubble, call it whatever you want. There's a ton of speculation in these markets. And the Fed is in a different situation. The Fed can just keep providing liquidity. The banks at some point can't. And they have concerns of their own. So we have a Fed that's constantly supporting the capital markets, the financial markets, and it's very hard for the Fed to say, you know what, we're going to let this bubble burst.
Right.
Not that the banks did that, but they backed away from the markets. They wouldn't lend. The Fed can't do that. And I think that's, if there's just one, you read the whole article and you say, this is all regulatory, I don't know, wonky stuff, I don't know what he's talking about. If you just kind of read the last couple paragraphs, what we've become is a liquidity regime led by the Fed. And the good part is it's stability. The bad part is stability ultimately breeds bubbles and speculation and gross excesses in valuations. And it's not clear how the Fed's going to allow that to normalize.
Well, again, but assuming that the Fed, so let's go back to what you said, though. The Fed really can't afford to let the markets crack, right? They don't want to have another repeat of 2008 by any stretch of the imagination. So they just keep doing this, and which means that basically fundamentals don't matter and that this bubble lasts forever, in theory, right?
Yes and no. We're kind of at the other end of that spectrum now, and President Trump has talked a lot about banking deregulation. It's very well known, and guys like, bankers like Jamie Dimon have made it very clear the harm that like SLR, LCR, all these regulatory capital rules, not just on them, but on the whole financial industry is causing. So it's very possible that we get banking deregulation, which puts the ball somewhat back in the private market. And, you know, it all comes around full circle. You learn your lesson in 2008, you set a whole bunch of guardrails, then you realize those guardrails have their own issues, you change them, and that's how the system works and always has worked. So the Fed and the private markets are going to learn a whole bunch of new lessons at some point in the next, in the future here.
Right. Well, again, and that's, I guess then we go back to, but again, this is also the big issue is that, there's a lot of people running around like, oh, look at the bubble and valuations, all these other type of things. And there's some drivers to those valuations that are keeping those valuations elevated that we've seen really since 2008. Valuations have been high and they continue to be elevated. And when you even do have corrections, you immediately get a bailout from the Fed. 2020, 2022. The Fed stepping in some form to bail out, Silicon Valley Bank crisis or, COVID, whatever it is. And so you just kind of keep the game going. And now you've sucked in all the retail investors to basically buy every dip. I posted a chart on Twitter this morning, or X, showing that now even professional managers have now gotten into the buy the dip game. So, retail investors have been doing it since 2020, and now professional investors are stepping in, buying the dips as they come along because it's, you've got to perform with the markets. This is, if you don't perform with the markets, you're out of a job. So you start doing what the markets are doing. And so you start buying every dip. And again, there doesn't seem to be any risk. This is the moral hazard that we've spoken about before. The Fed has provided this insurance against downturns, which now people go, well, there's no risk. I just buy stuff and it goes up. And if something does go down, that's okay. The Fed's going to bail us out. But the question is what happens, why would the Fed not bail people out now at this point?
Right. And this is where the Fed's dual mandate comes in, right? It's employment and inflation. And let's just focus on employment. If they let this thing burst, the unemployment rate's going to skyrocket. So they have kind of their economic duty to keep this bubble going. And part of the problem is they provide liquidity, but that liquidity having trouble with that word today, is distributed by the financial sector. So while the Fed can say, here's liquidity, we only want you to use it on treasuries and high-grade corporates and mortgages, the financial sector will do whatever they want with it. So it's going 5 times leveraged ETFs to crypto, to gold on margin, to highly speculative stocks on margin, to private equity, to a bunch of speculative things, some of which have no value, no real productive value. So that's where the kind of disconnect comes in into the market. And will the financial markets learn their lesson again? And why should they? They know they have the Fed backstopping them. So it's not just by the dip, it's we got Fed liquidity and the Fed will never really take away liquidity.
Yeah. And this was one of the arguments for a long time that, in 2010, 11, 12, 13, 14, the markets are going up, the Fed's doing QE. And, a lot of people were saying it's like, oh, QE doesn't impact the financial markets, but it does because when the Fed provides liquidity to the banks, it's the hedge funds, it's the money market funds, it's people going to the repo window that's getting that leverage into the system. So this all directly relates ultimately to why asset prices keep going up because all this liquidity is finding its way into the markets, not just dollar for dollar, but on leverage because this is where the leverage is coming from.
That's a good point. When the government spends money, they're writing a check to this company that's going to rebuild a bridge. They know well, I don't know if they know anything, but they in theory are allocating money towards projects and they know whether they're productive or unproductive and their investment value. The Fed just distributes liquidity. They're just writing blank checks and it's up to the financial sector to distribute that money. whether it's for great causes or for speculative causes. We don't really know. And the Fed doesn't really have any. There are some guardrails, there are capital requirements, and there are things, but largely they don't have the same. It's not like the government when they write checks.
Right. Well, and again, just to clarify, because I don't want anybody to walk away from here going, "Oh, the Fed's printing money." The Fed doesn't print money. As Mike said earlier, they create reserves, and this is a digital transaction between the bank reserves, Fed reserve accounts, and the Federal Reserve. So it's the bank provides the bond. So they basically give a bond to the Federal Reserve, and the Federal Reserve credits their reserve account, digital ones and zeros. It's just an asset swap. There's no money being created. There's no increase in the M2 money supply from all this. The money doesn't get created until the bank takes those reserves and loans it to somebody, either for a mortgage or to a hedge fund or to a money market fund or whatever they do with those reserves. That's when the money gets created. It's when it gets loaned to somebody else.
So I think back to your question, how does this speculative phase just not continue? And I think the answer is something like a shock to the financial system, a Lehman Brothers moment where the banks are, I don't even know which banks I can lend to, let alone any other financial organization. You can give me all these reserves. I'm just going to sit on them.
Right.
Give me all the reserves you want. I'm not lending them because that's the distribution mechanism. And then the Fed will open up their facilities to bigger and bigger, more financial entities and eventually solve the problem. But it takes, as we saw in 2019 and 2020 and all points, even 2008, if you remember, they did QE early and the market just kept dropping. And that's because the banks were so scared to lend to anyone. The markets had frozen up. So they put a bunch of reserves in the system, but those reserves weren't being put to use.
Well, and this is a kind of the overriding question of today's conversation, which is there's a lot of people making videos or whatever, writing articles saying, oh, the market's about to crash, it's about to all come tumbling down, it's a house of cards, whatever it is. But again, if you kind of just get into the very functional foundation of how money is finding its way into the system, there's no real evidence right now that, again, you look at credit spreads, you look at, kind of other credit markets itself. We don't really have a subprime crisis looming, right? You've got some issues with some subprime auto debt, but that's a very small factor to the function of the overall credit market versus subprime, which was magnitudes larger than, what's going on with some of the auto debt. So there's certainly some cracks, but there's no evidence that it's providing real strain on the banks at this point.
Right. And what I was kind of thinking about, what would, if they made me the Fed chair, what would I do? How would I deal with this situation? And I think the answer is you manage liquidity to its minimum. So you don't provide too much. You provide enough so that the economy can go on, that the markets can function. But you start taking away enough liquidity so some of that excess uses of capital, like the speculation, you try to get some of that out of the market. And that's not an easy job. And again, the Fed has no clue really what the right level of reserves is. And if you just drop it by a little, it can have a big effect, big impact.
Right.
And same with adding it. But the point is, try to manage liquidity so the market doesn't know it's abundant, so that the banks allocate it better, that they allocate it towards the more productive uses of capital versus speculative. And if you can somehow take some of the bubble out of the market without the market crashing, you've done a tremendous favor for the U.S. economy.
Well,
for the people.
Yeah, the question could be could you restrict the flow of leverage from the reserve accounts of the banks to the hedge funds, right? Cut off that source of liquidity, or at least reduce it, right? Yeah. Right, and others, right? So, or at least reduce it. So if I'm loaning out 10 times leverage or 20 times leverage, whatever it is, you put a leverage cap at 5, right? 4, 3, whatever. Right. And that would certainly slow that rate of liquidity flow into the markets. It would certainly damage the financial markets, which is starving for liquidity even right now. But it's again, you could probably do something in stages to where you could reduce that liquidity flow to slowly kind of deflate the bubble and get kind of asset prices back in line with valuations.
Right. Right. And I'm not saying that's easy. That's an incredibly hard task. I don't even know how you would go about figuring out what those levels are. But like you said, there's 500 PhDs that must be somewhat smart. Maybe they can figure something out.
Well, apparently they don't. So we just keep we just keep running the same playbook over and over again. So it's just like, oh, there's a crisis, throw liquidity at it. So there you go.
Well, Lance, maybe you can move to DC and the two of us can go work at the Fed, figure it all out.
I don't have my PhD, unfortunately, so I think that's
fortunately.
Anyway, all right. That kind of wraps up the show for the day. Be sure and like and subscribe to the channel. We appreciate it very much. Also get by the website. Mike's latest article on the website now, realinvestmentadvice.com. That is realinvestmentadvice.com. The entire article about this liquidity issue in the markets, it's on the website, along with our latest article on money printing by the Fed, fact or fiction. That's also there, which goes into this whole idea of how reserves are created in the markets. So again, both of those articles, really good kind of good detail behind today's conversation if you need more to work off of. So anyway, that's on the website, realinvestmentadvice.com. Be sure and like and subscribe to the channel, and we'll see you back here tomorrow for the next edition of The Real Investment Show. Have a great day.